Okay, good morning. Is it working? Yeah, okay. Good morning, everyone, and welcome to this session. I was told by David that I should wait until everybody's here. So I think everybody's here, so I think we can get started. Maybe we can close the door. So my name is Ben Arrindell. As you would have seen in the brochure, I'm an international tax consultant, and I've had well over 30 years of experience of international tax consulting, first with the accounting firm of Ernst & Young for 26 years, and I started my career in the UK Inland Revenue in international division in London. I retired from Ernst & Young just over 4 years ago, and now I do quite a number of international tax consulting assignments. So I'm going to talk to you about the changing face of international tax planning and the effects on offshore financial centers, particularly in relation to the recent developments that we have seen in the international arena over the last 10 years or so. I think it's fair to say that those developments have made international tax planning extremely challenging. As I say, I've been in this game over 30 years, and it's certainly the most challenging time for international tax planners. In my presentation, I'm going to examine some of those international developments and the effects that they have on international tax planning and offshore financial centers. That is not to say that offshore financial centers are only used for tax planning purposes. I mean, I think we all know differently. But certainly it plays an important part of what international offshore financial centers are used for. So, way back, I think it was in the 19th century in the UK, Lord Tumlin, in the case of the Inland Revenue Commissioners against the Duke of Westminster, said that every man is entitled to order his affairs so that the tax attaching under the appropriate acts, and that is the income tax legislation, is less than it otherwise would be. Now that statement was the start of the concept that tax planning and tax avoidance was legal, and that it was okay, whether you are an individual or a corporation, to order your affairs in such a way that you minimize the taxes that you pay. And certainly for many years, that is the precept on which tax planning, domestically and international tax planning, was done. In recent years, we have seen a blur between tax avoidance, which is legal, and tax evasion, which is illegal. And in my presentation, I won't be dealing with tax evasion because none of us get involved in tax evasion. I'm going to focus on tax avoidance and how that blurring of the edges between tax avoidance and tax evasion has developed, I would say, over the last 10 years or so. So first of all, I'm going to examine some of the concepts that are being used by tax authorities around the world and have been for many years to counter tax avoidance. Because even though tax avoidance is legal, that doesn't mean that tax avoidance schemes cannot be challenged by the tax authorities. And that certainly has been the case traditionally. So there are different ways in which the challenge can be made. The most common and probably the oldest is what we call general anti-avoidance rules, GAR. And those exist in many countries: Canada, the Netherlands, South Africa, Australia. And in 2010, the US introduced the general anti-avoidance rule, GAR. In the budget in 2013, the UK Chancellor proposed that the UK will introduce GAR legislation for the first time. I think he said in his statement that the introduction of a GAR will bring in something like about £4.6 billion of additional tax over the next 5 years. So what is a general anti-avoidance provision? Well, basically, it's a provision that essentially says that if you enter into a transaction or a series of transactions, and the main motive of that transaction or those transactions is to avoid tax and has no business purpose, then the tax authorities can set aside those transactions and to charge tax as if the transaction